Manish, thank you so much for appearing on the Wizards of Dalal Street.
Thanks for having me on the show.
It's a pleasure, Manish. You know, there's a very popular book, All I Wanted to Learn, I Learned in Kindergarten. You learned investing from watching your portfolio?
Yeah, I mean, the story began some 25 years ago, you know, after I passed out of class 12.
Yeah.
And I was a science student, obviously inquisitive about the know and, you know, how and why of things. And my dad is a practicing chartered accountant, so he had some stocks in the portfolio which always did well. You know, he used to get good dividends, and the dividends increased every year. At the same time, there were some stocks like Tata Iron and Steel, you know, which
very cyclical.
Very cyclical. They went up, but they came down. Dividends were erratic or not there. That made me wonder as to what made stocks move.
But let me take you to 2004, Manish. The Motilal Oswal of Motilal Oswal called you for a job?
Yeah, I mean, that's correct. You know, one fine morning, sometime in July or August of 2004, I actually got a call from him asking me whether I was keen to join them.
Do you think it was a crank call?
No, I didn't. You know, the serious voice that spoke on the other side, obviously it was...
Convinced you.
Yeah. So he wanted me to come over to Bombay and face an interview with Mr. Ramdev Agarwal and himself. And if I could have cleared that, you know, obviously he was willing to hire me. So, you know, I came, I gave the interview, and I got selected, and now I'm here.
The early part that shaped your investment philosophy was where is the cash? How did that shape the first years of your investment business?
You know, I must say that whatever I am today so far, you know, is all been due to the learnings of this organization. You know, Motilal Oswal, that has created the foundation.
Buy right, sit tight. Huh?
Buy right, sit tight, and ultimately numbers don't lie, and what matters the most is the free cash flows of companies, not the P&L account profit balance. That's the determinant to the free cash flows, and if you're able to gauge how much cash flows a business is going to earn over a lifetime, you know, maybe next 5, 10, 15 years, it's nothing but the present value of those future cash flows. So that is what we focused on. And of course, Mr. Ramdev Agarwal, you know, he's a great teacher, you know, how he creates, how he goes about explaining how businesses are and what matters and what doesn't matter. And that created the foundation, made me perfectly believe that if you got to get stock prices right, you better get a handle on the cash that the company is going to make over.
Correct, follow the cash. But you know, as you progressed in your job, I've heard a lot of abbreviations in my time, SOS, IOU, GOI, PMO, but you guys believe in a different abbreviation. Tell me about it.
So the term is called QGLP. You know, this is nothing but the margin of safety. QGL is the value piece, P is the price. Difference between value and price is the margin of safety. So
Voila.
Value component has been broken down into 3 letter words, QGL. Q is the quality, as measured through quality of business and quality of management. G is the growth part. We want to buy growth businesses, so we are following a GARP method of investing. And longevity of growth is understanding whether the moat or the competitive advantage of businesses are structural or cyclical.
Well, give me a couple of qualitative and quantitative factors that are very important to you.
So quality, we have 2 components. One is the quality of the business, as measured through return on capital employed and free cash flows. And at the same time, the quality of management is quite important. So good business run by a bad management or a bad business run by a good management, answer is a not for you. You know, only if a good business is run by a good management, we'll have a winner. So understanding and gauging the quality of the management is equally important. And that requires a lot of experience and of course a whole lot of methodology, and we have evolved and developed few of the forensics that we use quantitatively to gauge whether the management is of high quality. And
One important thing is beating the return on capital, right? The cost of capital.
Absolutely correct. You know, in India, the cost of capital is pretty high. We have very few businesses, 65–70% of the businesses in India don't even earn cost of capital, just about meets cost of capital. They should be trading at maybe 1-time price to book. Very few companies, you know.
And don't deserve a place in your portfolio according to you.
You won't be beating the markets.
In certain stocks, you've not only doubled, but you made 40 times your money. One of them is Page Industries.
True.
Tell me, how did you chance upon that stock?
So of course I had some understanding about the hosiery businesses coming from Calcutta. You know, you have some of the old names.
Cozy, all are good names there, yeah.
Yeah, and if you went through the DRHP, in fact, we bought into the stock just about, you know, after the IPO came. So if you've gone through the DRHP, you understood how the businesses actually were very successfully managed by them in the Philippines. And you know, if you did some internet research, desktop research for yourself, you would have been able to figure out what they were intending to do. Then it was all about going to the factories in Bangalore and understanding, what they are wanting to do. And obviously it was an aspirational brand, you knew it. Because the American brand, 100-year-old product, here they were positioning the product at a very reasonable price point. So they were offering value for money. Market was expanding, they were doubling every 5 years. He was present in the mid-premium and the super premium category, which was growing faster than the market.
Manish, what was his moat?
I mean, his moat is his distribution, according to me. And this distribution advantage which he has will be there even today for the next 10 years.
So, despite the stock doubling and then doubling and then doubling some more, what gives you the confidence to stay on? Is it the sheer numbers that come every quarter?
Long term is made up of many short terms, and if the short term, the numbers do come, you just got to figure out what should be the terminal value. And terminal value to determine, you understand the competitive advantage, the nuts and bolts of what will make that number. As long as you are confident about these numbers coming, then it is just extrapolating what is the prices to earning multiple that should be for that business.
Yeah. Another stock that has been very successful for you, let's go through their strategy. Eicher Motors, stock's been a fabulous stock, one of the great winners of the 2007 bull market. You spotted it young.
Yeah.
Tell me the exciting story behind Eicher.
So Eicher had been, a fascinating story, but we looked into Eicher initially for their trucking business when they tied up with Volvo.
Course, yeah.
They opened the JV, but it was not doing that well. They were going about it, but slow and steady. Then I happened to read an interview of Mr. Dalal.
Correct.
And he was also equally optimistic about the Royal Enfield business. But it was meager numbers those days, 50,000 units, in a category of motorcycles where numbers were big even in those days. The entire category was growing doubling every 7 years. So growth rates were 10-11% in volume terms. Here we were talking about a company which was selling 50,000 units, but it was an aspirational product. The name is owned by the British Navy, Royal Enfield.
Of course, yeah.
And the Bullet and the Classic 350, which are the best-selling bikes. It just kept on ramping numbers, and margins kept on increasing.
He had a sweet spot in terms of segmentation, you say?
Absolutely. He does not compete. He has created the segment for himself. He does not compete with scooters. He does not compete with commuting motorcycles. He does not compete with ultimate leisure biking.
He owns the segment.
He owns the segment, and even today there is no major competitive, competition that is coming through. If he has priced his product very sweetly between 100,000 rupees to 1,50,000 rupees, that range, he will continue to be a winner. There are, of course, competition trying to position their own products within that segment, but he's miles ahead of them, and to get latent demand in the system for these sort of bikes is roughly around 2 million units. Today he is at 600,000 units.
A lot of headroom.
A lot of headroom to go, and the market hopefully should be growing at about the motorcycle category growth rate for long periods of time.
When you first buy a stock, Page, Eicher, or anything else, is there a bit of heart pounding goes on? Are you unsure? Do you know that's going to be a winner? Is there something that your bloodstream tells you?
So mentally you try to figure out the P&L account model, at least for the next 3 years. Looking beyond that is difficult to take a call on. But based on my understanding about the business, what would make money for those businesses, just try to figure out how much money this business is going to make in the next 3 to 5 years.
So it comes down again to numbers and cash flow.
100%. Nothing else works according to me, the value investing is understanding growth investing. As far as India is concerned, Benjamin Graham's definition of value, the strictest definition of the term would not apply to India, because obviously bulk of the businesses are earning less than cost of capital. How does low PE stocks, would make or create wealth for you? It's about growth, understanding growth, and how much cash flow these businesses are going to
And the way India is shaping up, there are and there will be a lot of structural stories coming through with good quality management. So investors, have missed Page and Eicher, can either buy Page, Eicher again, or some other stocks. Do you feel that opportunity is still there?
Today, bulk of the value is getting captured in the private equity space. But at the same time, we'll have umpteen number of opportunities even in the listed equity space. So yes, one thing which I look forward to also is to understand how much the profit pool is going to grow and how many players this profit pool is going to get shared with. So if you have consolidated sectors, I mean, I as a fund manager to figure out whether company A is going to do well or company B is going to do well or company C. If they all fit into the QGLP framework, my job is easier if there is a growing profit pool and a consolidated space.
You know, when you say profit pool, I can almost hear Ramdev speaking.
Of course, I am his disciple. I mean, there's no two ways about it.
It's very well said. You know, this is a world full of buy today, sell tomorrow, and the courage and conviction with which you make your calls has been exemplary. Thank you so much for being a part
Thanks,
of our
Ramesh
show.
ji. Thanks for having me.
We'll see you next week on another episode of The Wizards of Dalal Street, A Fresh Breeze.